Hello everybody. In this module, I want to talk to you about EBITDA or EBITDA. EBITDA, as I'm going to call it, is a well-known key indicator that identifies to users of financial statements how the business is performing. What makes it attractive is that EBITDA allows different companies from different industries to be compared to each other regardless of their differences. Let's have a look at EBITDA and how you can use it to compare your business to your competitors or that of totally different industries. So EBITDA stands for earnings, which is profit, before interest, tax, depreciation, and amortisation. As I said, it's a widely used indicator of business performance, again, in line with our themes at the operational level. So let's just delve down a little bit deeper. EBITDA measures the operational performance of a business before the effects of gearing, which is interest, capex or purchase of PP&E, which is represented by depreciation, acquisitions, represented by amortization of goodwill, and taxation. So EBITDA is a clean profit, operating profit figure before the impacts of those four elements: gearing, capital expenditures, acquisitions, and taxation. Just some things about EBITDA. By excluding depreciation, the indicator reflects operating performance before capital spend decisions, as I said above. So if we have two different companies in two different industries, and one industry is highly capex intense or intensive, as we said, high capex diet, have to spend a lot of capex year on year, and you have company B that is a service company and very little capex. If I look at their profits after depreciation, I'm going to get a very different figure and an indicator of profitability. So let me ignore capital requirements, and now I can start seeing how are we comparing two businesses that are not in the same industry, and I can see which one is being managed more effectively. If I then look at, if I exclude amortization, I then get to a clean profit figure that ignores one company which may be on an acquisition trail and there's goodwill on its balance sheet, and therefore they're writing goodwill off over time as an amortization cost in the income statement, and company B has no amortization. They grow organically, as I said in one of the earlier modules. I can now exclude that out of the picture, and I'm getting an apple like apple comparison. So EBITDA allows comparison of a business's operating performance across industries, as I said. That's why it is used. But not only that, there is some negatives, like most things in life, around EBITDA, and the biggest shortfall of EBITDA is that it does not adjust for working capital demands. And as you saw under cash flow, working capital, when we re-engineer the profit figure to get back to a cash profit figure, we have to take into account any movement in working capital. EBITDA does not. And so therefore, it does not measure management's efficiency or non-efficiency in managing credit, that's your receivables, what your customers owe you, and your inventory, two big items under working capital. Additionally, EBITDA does not take into account any capex intensity, as we said, of a particular industry. And in some industries, you cannot make profit without spending capital expenditure. So this is a crude measure of cash profit. It does not include working capital demands, and it does not include capex expenditures. Two big drains on cash. But still, as long as we know what EBITDA is, it allows us to compare the efficiency in management, turning revenue into profits from one business to another, from one industry to another. Let's go and have a look. Here we have in front of us a financial statements of a SME, small medium enterprise. So we have the 2 years here, 2011, 2010, and we have our calculation of EBITDA. How do we start? We start with profit before interest and tax. Where do we get that number from? Hopefully by now you all know you get it from the income statement. So if I go to the income statement, I find it here. Operating profit happens to be the same thing as profits before interest costs and taxation. So I take my 439,000, which I have there, and I add back depreciation and amortisation, if any. In this business we've got 17,000 for this year of depreciation, because remember, in getting to this number, profit before interest and tax, that is net of depreciation. Let's go and check it out on the income statement. There we see our profit before interest and tax, that we have a depreciation charge in our overheads getting to that number. So back to our analysis. We then arrive at EBITDA of 456,900, and we do some KPIs, key performance indicators. One that I like to use is revenue divided by EBITDA to give me the EBITDA multiple. So I'm dividing my sales revenue turnover by my EBITDA figure. And because my EBITDA figure is growing, I would expect, if I'm growing my profits faster than my turnover, I would expect my EBITDA multiple to start declining year on year. So a declining indicator in this instance is a positive indicator. Remember, as we saw earlier, this EBITDA number is before our capex requirements and before how well we, or not so well, we are managing our working capital. I then do an adjusted EBITDA after adjusting for capital expenditures, and in this case an outflow of working capital. So we didn't turn all of our EBITDA into cash, and I take that resultant number and I do it as a percentage of operating profit, and I see my adjusted EBITDA has declined from 103% to 90%, indicating a different story at the cash flow level. At the profitability level, my multiple is improving from 8.6 to 6.5, but at a cash flow level, my EBITDA adjusted for cash flow items has declined from 103% to 90%. So just doing that small comparison using EBITDA, I'm able to see that this particular company improved profitability, but cash flow not so good. And I could do this comparison across industry, across multiple companies, to see which set of management teams are performing better than the other. That's EBITDA.